Money, a special show where we feature marquee guests with decades of experience. But the special guest on the show is you, yes, our viewers.
Don't pick up stocks too early. Pick them up when they have proven themselves.
Investing lessons from India's most trusted market gurus. Join us as we decode, debunk and demystify the markets.
As a beginner, stay away from all these fancy theories and miracles floating around in the market. Stick to companies that you have used as a consumer.
Tune into Smart Money at these times. This is TV 18 and you're watching CNBC TV 18.
Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. And the commodities have been on a tear since month of March and have surged to the highest level in more than 6 years, with rallies in everything from iron ore to soybeans, copper and corn. Global banks and institutions have endorsed raw materials as investment plays and predict that they have more room to climb. But how has the Indian investor made use of this opportunity? So the questions we're asking our experts on the show are, has the Indian investor warmed up to commodity in their portfolios? And are there enough instruments available? Joining us on how to take this forward are Kunal Sodhani. He's Associate Vice President of the Global Trading Center at Shinhan Bank, India. Ramesh Varakhedkar is Head of Commodities and Currency at ICICI Securities. And Sunil Khatke is Head of Commodities and Currencies at Axis Securities. Gentlemen, hi. Thank you so much for joining us on the show. The first question, Ramesh, I want to ask to you is, have the Indian investors been able to make use of the run-up in commodities? Do you see it as a considerable part of their portfolios yet?
Yeah, there has been good retail participation in this commodity run-up, especially when the equity markets were down and the gold was rallying. There was a lot of participation happening in gold, silver. And now in the recent past, the activity in the crude oil has also gone up. The reason being, after April 20th, where crude oil prices went negative, the margins had gone up too high. Now that has been rationalized. And in recent last 1 month, we could see good participation in crude. So basically, there has been good activity on bullion, good activity on crude oil, and the retail participation has been increasing on this.
Ramesh, but are you, satisfied with the kind of or the number of participation or the growth on year-on-year basis that we've seen in the Indian markets of a general investor?
I feel there's still enough headroom. There's a lot which can be done. So even today, our markets are pretty shallow. Options are not pretty liquid. Most of the volumes happen in futures only, and that too it's concentrated on bullion, energy, and a little bit of base metals. So still there's enough opportunity. Bullion index and metal index has been launched. There has been decent traction, but with indices coming up in commodities market, which is a good participating tool for retail investors because there's no delivery, I believe still there's a lot which can be done. Most important is a few years back, SEBI also allowed mutual funds, AF, CAT3, PMS in commodities, but there are few mutual funds who have started multi-asset fund. There's a lot which can be done on mutual fund side also, where the retail participants can come in and participate into commodities. So there's enough headroom, a lot to be done, and I am optimist saying commodities market would be doing well going forward.
Oh, well, optimistic we all are. Sunil, same question to you. And as Ramesh pointed out, yes, there are mutual funds and there are commodity indexes as well right now. And the commodity prices have run up so much, even as there has been COVID. This is perhaps one sector that had a lot of enthusiasm going for it. But have the Indian investors been able to add enough into their portfolio to make use of this?
Hi, Manisha. I think most of the retail participants may have actually missed the rally that we witnessed from 42,000 level to 56,000 rupees per 10 gram rally that we witnessed in gold. I think a lot of retail investors were not able to encash upon that. A lot of institutions were actually able to make the most of this rally that we witnessed in gold. But having seen 56,300 rupees high, now the prices have again come down. to close to 46,000 rupees. So we are seeing a discount of 10,000 rupees from the recent prices that we had witnessed in August. So I think this has actually increased the interest level of people who missed that rally, and now we are able to see retail participation increasing in the form of ETFs, or it can be in the form of gold bonds, or also we have seen good volumes being seen on gold on the derivative platform. Even though the option contracts are not liquid enough on MCX contract, but still we have seen a decent surge in gold volume if we compare it with year-on-year numbers. So gold mini contracts have actually managed to touch the record high turnover, and even the number of retail people taking gold mini or gold guinea contract delivery has actually increased, which means that people have now actually started seeing gold as a part of their portfolio. And earlier, I think gold only used to contribute 4 to 5% of overall portfolio, but now that percentage looks to be going up to 15 to 16%. In terms of retail, portfolio size, if we talk about, I think gold has actually managed to get 30% weightage in the overall portfolio. So this means that people have now started seeing the volatility, and they have started using the instruments that are available digitally. And I think people have actually made the most of the volatility over past. The institutionals specifically have managed to generate decent revenue, but the retail participant looks to be driving this market ahead. And not only gold, but I think even silver prices we have witnessed decent rally, and now the prices are trading close to 68,000 a kg. But we have recently seen 78,000 kind of levels being seen. People are more bullish on silver, and we are actually seeing decent open interest being built in silver as well. So overall, I believe from the retail perspective, the prices are very attractive. If you're willing to buy in the physical market, obviously you'll be blocking a lot of money. I think the digital platforms have been thriving, and people have managed to learn how to trade or invest digitally during the lockdown period. And now I think they're prepared, and I think this is the right time because the prices are attractive, and people who missed the rally last time, they are able to actually make the most of this.
All right, so the commodities that are favorites with Indians clearly have been gold, silver and crude, and that is where we've seen a lot of traction come in. Kunal, this one is to you. We are talking a lot of terms here on whether or not the Indian investors per se are comfortable, are they aware, do they understand commodities, and are there enough instruments available really? What is your sense?
So thank you, Manisha. First of all, I think there has been a whooping volatility across asset classes, maybe equities, even commodities. But I think sometimes we have a cause and lag effect. So when the rally started, across the asset classes, I think equities were the ones where the eyes were on. So if you see, particularly from 12,000 Nifty to 15,000 Nifty, the retail participation somewhere was shifting more towards the equity front. But again, as I said, cause and lag, cause and effect, that may not be at the same time. Slowly and steadily, people have started realizing, that, is it an overwhelming participation happening on the equity front? So people have started shifted, retail participants particularly have started shifted to commodities as an important asset class, particularly bullion and oil. So if you see oil, I think a whooping, again, surge was seen around 218% from April 2020 till date. But I think if we talk about the percentage return an investor or a retail investor might have got from that 218%, I believe hardly countful of people might have contributed, adding to that value of income they may have made for themselves. So yes, retail participation at this time is growing because there has been a shift from the asset class because of the assumption of the over rally, in particular global equity markets and domestic equity markets. So that is one point. Secondly, I would again say that the regulatory perspective, the regulators have been pushing forward for new product array. They have been speaking to several brokers, banks, to try to understand, what could be the requirements, even to the customers directly, to understand, what is the ground reality and how do we ease this product, for the retail or the end consumer. Now, the third thing I want to add on is people have started thinking after the news, has been by the big broking houses, of the rally expected, So obviously, if you see from 2008 till 2020, a 12-year upswing in commodity has been seen. But again, retail participants were not there. It's again the institutions or the hedge funds who have made most out of it. Several 4-5 reasons I want to attribute to the retail investors also, to promote how commodities can be an important part in your portfolio. One, if we are seeing easy monetary policy, coming, particularly in the next 6 months also, even if we read what the Fed is saying, they are still being accommodative in their stance. So we are expecting a deteriorating dollar, possibly, going forward.
Sure.
And thus more participation may shift towards the commodity front, because there is also expectations of growth in China. So if we see the manufacturing numbers of the manufacturing of the service numbers, they have been going right for the China's perspective.
Absolutely.
Again,
So, Kunal, your point is very well taken, that there are a lot of reasons where we've seen commodity prices run up, and there will perhaps be more reasons that we will see this space do quite well. But my question really is, and this one is to you, Ramesh, that, we've seen a run up in commodity prices. And as Sunil and Kunal both put it out, that retail participation has been there. And in the international markets, the run up has been because of the hedge funds and institutional participation, which India perhaps has missed out on. So when it comes to instruments, are there enough commodity instruments available to invest in? I'm not talking about retail participation. I'm talking about investors class here. I'm talking about portfolios here. What kind of opportunities are we looking at? What have been the challenges? And what instruments does India really need to make that foray into commodity in sense of mainstream?
Yeah. If I look at the commodities, currently we have only gold ETF in India. Unlike global markets where you have ETF on silver, you have a different variant ETF for crude oil. But in India, it's only gold which is there. So that's one thing which is being missed. So we can also explore and have other ETFs like silver and ETFs on the crude oil. That's one thing which the market may require. Second thing, as I mentioned, mutual funds has been a good route, which is there where all the investors, HNIs also can come in. Third thing is, for the investors, the biggest challenge is on the delivery. If somebody wants to invest in commodities for a longer period, there is deliveries which is available. But there are delivery centers like copper in Bhiwandi or cotton in Kadi. And if some investor is in Ludhiana or somewhere down south, the challenge is on the GST. He needs to have a GST number for his respective state wherever he is, and a GST for the location where the delivery will be done. So since it's being traded on the national exchange, which is NCX, I believe there has to be some tweak on the GST norms which should happen so that people, HNIs, can invest into these commodities, and they'll be able to take advantage, and they'll also be able to buy, sell, and move these commodities from those places.
So, Ramesh, would you say that you're hopeful that we will be able to solve all these challenges as we move ahead and be in time to make use of this rally?
Yeah, I believe yes. Copper has hit all-time high. We have seen silver going up to 78,000, now trading at 68,000. So I believe investors should be able to make good of this rally.
All right, point taken. Ramesh, on that note, we'll let you go. Thank you so much for joining us in for that participation. And with that, we'll go for a break as well. But don't go anywhere, because this discussion continues when we return. Welcome back. You're watching Commodity Champions, and we have Kunal Sodhani and Sunil Katke still on with us on the show. And I want to take full focus onto the gold prices now, because in this week, if there has been a major mover, that clearly has been the gold prices, where we've seen prices hit 8-month lows. We've seen prices continue on a decline for this year, down by more than 5.5%. And from its all-time highs, we did see gold prices come off by nearly 20% as well. Sunil, this question is to you. Well, we've seen risk appetite continue to grow. Equities and US dollar and treasury yields have run up, and that clearly has had its impact on a safe haven that we call gold. But there have been a lot of investors who've bought gold on higher levels, but with the kind of damage on charts that the gold has seen, where do you see strong, important, critical supports now come in?
Yeah, Manisha, I think the gold prices will certainly find support close to $1,750 mark. I think we have seen a decent jump in treasury yield, like you mentioned. They're trading at 1-year high. And even some asset managers have actually shifted their investments from gold to silver. So that has kind of triggered some sell-off. And trading below $1,800 mark, again, it triggers some short sentiments. So I believe the prices are bottoming out. So people, as an investor, if they've bought for 3 to 6 months time horizon, I believe these are not bad rates. Any price near $1,800 mark in rupee term, 46,000 kind of price is not a bad rate at all. But in a very short term perspective, if somebody is looking at 2 to 3 days perspective for gold, I believe another $30-40 correction can be witnessed at COMEX, and that $30-40 correction may actually convert to 45,800 level or 46,000 kind of level. So another 600-700 rupees correction is due in the very short term period because of the strength that we have seen in dollar index at the moment. And like I mentioned, some increase in risk appetite is triggering the technical.
Sunil, no, I don't want a very short term perspective from you. We're looking at investors here. We're looking at positional traders here. So, there have been reports circulating on that if 1750 breaks, we could be looking at 1720, 1700 kind of levels as well. So when we talk about, let's say, this quarter itself for the month of Feb and March as well, what kind of support levels then are you looking at? And would you also advise buying for a longer term at these levels?
Yes, Manisha, I think the broader fundamentals are positive with lower interest rates for next couple of years, with increasing inflation, with a mega stimulus package on the cards. I believe long-term investors, are kind of well placed buying gold at this level. So 1750 to $1775 level is what I suggest people with 3 to 6 months time to enter gold. And they can again expect the prices to reach close to 1850 to 1900 mark in the coming 3 months time. So with the broader fundamentals being positive, I think the investors and fund managers will again come back because these prices are attractive enough for institutions to again start building their AUM on the gold front. Because like I mentioned, over a period of time, we are going to see depreciating dollar, and that is going to support gold prices.
All right. You may not be in money today if you bought gold at higher levels, but these are good levels to buy as well. Kunal, what's your sense? Because Sunil very clearly put it out that he would rather buy silver than gold, and there are investors who are actually doing that. So if you had 100 rupees in the kitty, how would you divide it between the two precious metals?
So basically my take will be gold as compared to silver, because I think silver, particularly from a retail perspective, creates more volatility as compared to gold. Secondly, gold possibly, when we talk about retail investors, they have more universal acceptance within themselves, as gold being a commodity since, their childhood, they have been seeing these. Currently, if you talk about the reflation rate and the 10-year, US Treasury moving towards 1.33, two things I want to highlight, which is very important. One, in 2012, in 2016, and in 2019, 10-year UST was around 1.5%, taking a support there. And after the pandemic, it broke. So the fear of, it approaching back towards 1.5% and breaking that is causing dollar index to move high, and in turn commodity like gold to move left below 1800. But if we talk about clear number, I think 1720 to $1730 remains a very crucial support. If we see the screen, there will be a lot of buying seen around 1800 to 1780, $1800. There's a lot of demand seen, Secondly, there is also a set of people, who think they have missed it, So it rallied from 1800 till $2000. It came back from $2000 to $1800 back again. And now the retail participants are entering with the same anticipation, apart from the institutions and the hedge funds, which are already bullish because of several reasons, which you already highlighted. So I think 1720 remains the stop. We can definitely eye towards 1960 to $1980 towards on the gold front. That's my take. So this correction is interim. Reflation trade obviously taking place, that is happening, but overall trajectory remains quite positive on the commodity front. Dollar on a broader perspective still remains weak, though there can be some pullbacks which are necessary also, and those are interim in nature, some consolidation. But overall trajectory for me remains on the right side with a stop of 1720 for a target of 1960 to $1980.
All right, so 1720 to 1980 is a level that both of experts are talking about. Well, yes, you spoke about the strength in US dollar, the Indian import duty cut, and also the kind of decline in the global markets. All of that has led to some decline in the gold prices in Indian markets. But Sunil, if somebody was to make a portfolio when it comes to commodities, and in the first segment we did talk about on how there are some ways, various ways are still awaited. But for a commodity portfolio to, look like on what the global markets have done and the kind of run that we have seen here, if you look at precious metals, when you look at energy, when you look at agri as a mix, what would look like a strong portfolio right now?
I think gold prices and silver prices are kind of attractive enough for building a portfolio with a long-term horizon of 1 to 2 years time frame. Crude oil prices, they are totally dependent on how the things shape up as we move ahead, and the prices have already reached $60+ mark per barrel. So in a way, we are not expecting the prices to jump to 80 or $100 mark. So on the other hand, gold, I think overall a lot of large institutions are kind of even eyeing $2,300 mark for gold, and silver, as we have seen previously, it had touched $47 mark some 8-10 years back. Now there is a lot of scope. It is still trading close to $27 mark. So we have a projection of silver also touching a new high of close to $47-50 mark in a couple of years time. So if somebody wants to build a portfolio, I think gold and silver will remain their first choice. I can say that. And on the agri front, I think having 1 or 2 years projection from investment perspective, it will be a bit difficult because they're all cyclical products, and we will see the prices moving up and down based on the supply and demand factor. So they'll be very short term in nature, but pure from investment perspective, I believe gold and silver are going to be the choice of a lot of investors.
All right. So when it comes to commodity as a portfolio, gold and silver still top the list there. And then, of course, agriculture, you have to take a longer time view here. But most of the agriculture commodities as well are hitting all-time highs or near record highs. And you should be looking at those commodity prices also. Kunal, Sunil, thank you so much for joining us and helping us make that perfect commodity portfolio. Of course, much is desired and there are a lot of challenges, but there are opportunities as well, which we should be looking at. Thank you so much, gentlemen, for joining us. And with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.